Okay, investors. I don't know what happened today in the episode. My idea had been to run this live to go for a presentation, but I'm not quite sure what's happened. So for now, I'm not going to be able to stream this. So I need to figure this out in the future, how to go about it. But essentially, this was supposed to be a presentation where we're going to talk about when to sell. So this was a question that was put forward to me by Taylor, and Taylor helped me out and a lot with showing up to the show. And he kind of said, Michael, how do you decide when to sell? And that's really something that takes a lot of experience. And even Charlie Munger says that at the age of 98 that he's still trying to figure this one out, really when to sell. So I'm going to try and shed some light on it, how I think about it. Then we're going to talk about the crazy markets that we've seen in the last several weeks, particularly talking about the last 6 weeks. Then we're going to talk about understanding investing through 3 key variables. So here's the thing. Hopefully this is going to work. I'm hoping. So essentially, there are only 2 reasons really why you want to sell a stock. One thing is if you've made a mistake. By that I mean you've made an investment and you had some expectations in your mind. So this is not that they had one bad quarter or something. This is something fundamentally has changed. So I'm going to unpick that slightly. If you've made an investment where you're expecting the business to be growing, let's say pretend at 50%, and all of a sudden it's growing at mid-20s, something clearly is wrong here. And you've made a mistake, and that's fine. You should be upfront to yourself and unwind that position as relatively as soon as possible. Those occasions are very rare. More often than not, it's just a bumpy quarter and you need to just kind of get used to just sitting on your hands and doing nothing. The other reason why you want to sell a stock is because you've held a business for more than 12 months and you need to raise capital to buy another position. So when you're investing, you're trying your best to recycle what's kind of getting close to fair value to something that's meaningfully cheaper, looking out over the next 3-4 years. You want to keep adding a margin of safety to your portfolio. This doesn't need to be every month or even every quarter. But over time, you do need to kind of move slightly your positions to add some more margin of safety. So that's what I wanted to highlight as the introduction. So when should you not sell, okay? Don't sell the stock because it's dead money. Don't sell the stock because you're bored, because something new and kind of exciting has come around and you kind of seen this new IPO that has all the technological advances and has all the kind of buzzwords. That's not a reason to dump a position to go into something else. Don't sell a stock either because it's become too big a position in your portfolio. And I know we can talk about exclusions to every single one of these, but I just wanted to add some context. So according to Bill Miller believes that he, outside of the Bezos household, he is the biggest shareholder of Amazon. And he bought it in 2003, I think it is, at the last tranche. And he's just really held on to that. So he's made plenty of mistakes along the way, obviously the banks in 2008 and other things as well. And he's made some good gains like Avon that got acquired ultimately. So don't just sell out of a business because you've been too successful and picking a winner. Sell out of a business because there's something profoundly wrong with the business. So don't sell out of the stock just because it's too big of a part of your portfolio. It's really, really important. Buffett talks about that if you always picking, selling the winners in your portfolio, you end up and you just picking and you just, Peter Lynch talks about if you just picking the winners in your portfolio, you end up with a garden full of weeds. So just don't punish a business because it's done too well for you. That's really important to figure out. The next thing that I think is quite important is to let time do its thing. So your return is proportional to the time you've held the stock. Earnings over time should increase. As a consequence, you should be able to see your earnings compounding over time, and that should lead to you seeing your share price appreciation over time. Now, this is not going to happen over the next, let's say, 3 months or 6 months, but you should try as much as possible to get into the habit of sitting on your hands and doing nothing and letting compounding work. Next thing I'm going to talk about. So I just wanted to talk about a little bit about the buying process, okay? In the ideal situation, I'm talking about from my perspective, I'm talking about buying into a position where I expect to see a re-rating in the stock at some point over the 1.5 to 2 years time horizon. Making it a slow investment now, with the idea that what I'm buying right now, people don't really understand fully. It's a contrarian stock. It's a stock that people have one vision of what the business is. I have a different vision. And this is a relatively high risk strategy. But and this leads to a lot of volatility in the name, because you're taking a contrarian view. You're saying that the business is worth more than people give it value for. So over time, there's going to be indications that lead other people to believe that, but those indications can quickly dissipate and everything falls back down again. So you have to just be very accustomed to have the right temperament and buying very slowly into your positions over time. So however you're trying to figure this out, you're ultimately trying to buy something cheap today and sell it at a premium later. It doesn't matter if you call it value investing or growth or whatever. It doesn't really matter too much. You're not only trying to buy something for less than it's worth, but buying when it's out of favor with investors is really, really difficult, because at that time, it's not really like a crowd pleaser. Shareholders are kind of really much either disinterested in that business or there's a lot of negativity around that business. This does not mean you should go in and buy something just because it's falling in price. So don't be led by the price action. Try to follow a few key businesses and over time keep a small watch list, not too big. You don't want to have like just adding tickers to your watch list and then you end up with 30 stocks. Try and follow 5, perhaps 10 businesses over the course of, let's say, several quarters, trying to understand how the business is developing. And then if the price makes sense, then start to ease in. Now, this is really, really important. Don't put more than, let's say, 1.5 or 2% of your capital in at the start, and only add 1.5 to 2% over time over the next 6 to 8 weeks. Really kind of be quite slow coming into buying the stock and building that position over the course of 6 months to a year, and be quite slow at exiting the position too. But when you're looking for a re-rating, you are hoping that over the next 2 years, everyone's going to come around to see the business in the same way as you see it. I'll give you an example. This is a stock that I do own, and this is not for investment advice, it's just for illustration purposes or entertainment purposes. I own Fubu, so I believe that this business, over time, people will see it in a different light. I may be right or I may be wrong, but my idea is that by just sitting down and I'm waiting through it, I'm going to be able to see that happening. And if that happens, the share price will not be so volatile. Things will kind of smooth out slightly, and the multiple will be expanded. And at that point in time, in let's say 3 years, I would slowly start to ease out of that position. If I'm right, move in slowly and move out slowly. So that's what I want to talk about when you ask me about how to think about selling. I hope that this has helped somewhat. Next topic I want to talk about is the crazy markets of the last few weeks. So DocuSign is something that my inbox was full this morning. People were just asking me, Michael, what do you think about DocuSign? Should I get in? Should I get out? The first thing to note is it's quite difficult when you're kind of investing in a business that it's 50-50. Can work out, might not work out. Those are difficult investments to make, because when the share price falls, you kind of all half-hearted about it anyway, and then the share price falls and then you have to do something. And that's not a good position to be in. The first thing is to realize that you never have to do anything in investing. The share price going up or down 30% is not a call to action, okay? Unless you leverage, which you should not be, but unless you you should just learn very patiently to invest when the odds are meaningfully in your favor. Don't go for stocks that are 50-50, because in the case of, let's say, DocuSign, it's a business that I very much like. I like the business, okay, but people just kind of got a bit too excited about it, and this, I'll admit, took me by surprise, because I didn't expect them to see that deceleration happening so quickly. But it's not so much that the deceleration in revenue growth rates, it's more that the billings are a leading indicator of where revenues are going to go over time. So if billings are coming down as they pull them back, the billings are being pulled back slightly, the billings for Q4 are coming in at approximately 23% year-over-year growth. So that shows to investors that the booking pipeline of new contracts coming in that will ultimately be recognized as revenue is going to come down. So at the moment the business is growing, let's say 30%, but there's a gap because the billings are only at mid-20s. So that implies that over the next year the business is going to be growing at approximately, let's say, 25% CAGR. Now, analysts following the stock right now are saying that it's going to go at 29% CAGR. So if billings are going at 25 and analysts are predicting 29, there's going to be a lot of downwards revision over the next couple of months. And when you get downwards revisions, you get the analysts justifying the name why they've downwards revised their guidance, and they're going to put like loads of negative angles on the company, that they're not growing, that the poor execution, management fails, and they're going to just all these kind of buzzwords to kind of justify the fact that they need to downwards revise their guidance. And it's a bit of a PR spin as well, saying, oh, we're very bearish. It always sounds very good to be bearish a company. It's very profitable to be bearish a company. So what you're in this period where if you're a DocuSign shareholder and you're going to be over the next several months be on the back end of receiving all these negative comments, over time your patience is going to dwindle and your confidence in that business is going to be crushed. So you're going to end up in a difficult position, and you think to yourself right now, DocuSign is priced at 14 times forward sales. And there's a lot to like about the business. You know, it has reasonably strong free cash flow margins, approximately 10 to 13%. So it's a free cash flow generating business growing at approximately mid-20s, but it's priced at 14 times forward sales. And if you look elsewhere in the market, there are so many names right now that are growing in the mid-20s, priced at single times forward sales. I'll give you an example, Teladoc. I don't have any position in Teladoc, but there are plenty of these names right now that I expected to grow at somewhere in the ballpark of mid-20s that are priced at 4 times mid-single digits. Now, I didn't look through ASAN's, but I saw yesterday that, just quick snapshot, I saw that ASAN reported a result. I didn't really dig too much into it. But ASAN is a name that I've been saying, okay, I said it, you can look in my videos a few weeks ago, I said it a few weeks ago, I've been an unwavering bull of this name. I've been just a steadfast bull of this name, and I've seen the stock rally more than 300% since I was an unwavering bull. And in the last about 4 or 5 weeks ago now, I started saying, okay, you guys, you know, it's getting too expensive. And I said about 4 weeks ago that I can't see a justification any longer to be a bull here, and I'm stepping aside. And you can look that up on Seeking Alpha, you can look it up wherever you want. And the stock is down approximately 30% since I mentioned, 14% in the after hours market last night. And so my point is that the markets have been slightly crazy, and a lot of the big winners from 2020 and early 21, the market just pushing back and say no, not having any of that. And finally, Upstart, I noticed that Upstart is also down 50% since it reported its earnings, and it's just overall the market is saying, okay, we need to kind of get some sense of a bearing here. And I don't know if you remember, but before going into the Q3 earnings season, I said it very much depends how this Q3 earnings seasons go. Because going into the earnings season since the summer, growth had been leading the way, everyone been very, very bullish about growth names, and I've been saying depends on how we come out of this. If the market is able to take those earnings and everything is okay, then your growth is here to stay. If the market doesn't take this too well, you may consider moving into more of quote-unquote value stocks. These businesses that don't grow a lot, you're probably growing, let's say, somewhere between 5 and 10% on the top line, but they make a lot of free cash flow. You really want to try and price yourself to get approximately 12% free cash flow yield. That's just 1 divided by the free cash flow. So you want to try and not pay too much more than, let's say, kind of around 10 to 13 times forward this year's free cash flow. Obviously drops a little bit to next year, but doesn't drop that much because obviously doesn't have a lot of growth. But you don't want to be paying too much more than 13 times free cash flow. If you dig around, I'm sure you'll find some stuff. I think that this may be a good time now at the end or start of December to move towards value names. So these are the 3 variables. This is the last part of my presentation that I want to talk about. These are the 3 variables that matter in investing: your starting capital, your return, and time invested. Those 3 things. And really, when it comes to it, you can't do too much about your starting capital. That is what it is. You can and you should, at the start of each month, add a little bit more of your salary into your assets, but ultimately your starting capital is pretty much out of your control. Your rate of return is marginally within your control. You're going to have to try to work hard and compound close to 15%. That's really, really difficult, and it is a lot of hard work. But if you are able to even small amounts of outperformance at, let's say, 13% or compounded over time, is really, really significant if you do it for long enough. And that brings me to my next point. Your control in your total wealth is very much determined by the time you stay investing. So people would say to me, even last week or 2 weeks ago or 3 weeks ago, many people had actually been writing me, Michael, I think that there's going to be a crash. And I was like, okay, I don't know if there's going to be a crash or there's not going to be a crash. And it did turn out that there was a crash, but it doesn't matter. It's a time that you stay here. If you're not in a position that you have to sell out of your stocks, you don't have to sell out of your stocks. The stocks crashed and you just kind of, sit on your hands. And that's really, I know it sounds easy to say, and I know in reality that it is really, really difficult, but this is your best asset, learning to sit on your hands, because time is the biggest variable that you control. What you want to try and do is you want to try as much as possible to invest in high quality businesses. High quality businesses are businesses that have growing customer bases and make a meaningful amount of free cash flow. So if you are investing in businesses that have high quality, you're predisposing your portfolio towards compounding at high rates of return. This is really how you try and position in that equation. It's really how you try to position your wealth, is by staying invested in the market for long periods of time. So it's not trying to time the market. The money that you make is not in trying to get in and get out. It's not timing the market, but time in the market. It's the amount of time that you stay. And I always talk about the 20-year horizon or 20-year game. Is really you investing and staying invested for approximately 20 years, and you're going to maximize your chance of building wealth. So one more thing that I wanted to highlight just before we kind of wrap up here. So when you come to investing, you want to put the variables as much as possible in your side, okay? So the most important variable to think about is the valuation. That really predetermines how you're going to do, okay? Whenever you buy into a stock, just have a quick look on the proxy statement. Try and see how much management owns. If management owns, let's say in ASAN's case, their management owns a significant amount of stock, and the stock is really, really expensive, you can rest assured that they will do whatever they can to try to drive the shareholder value over time. If in the case, I don't have anything against DOCU, but in the case DOCU, you look at it and the CEO has 3% of the stock, and and he's the only one, there's not a lot of management incentive to drive this higher. So you're kind of in a bit of a limbo situation. So buy businesses that are out of favor. Think about the valuation to a certain extent. I mean, valuation is an art, it's not a science, but do compare to see going forward relative to other peers in the space, whether you get a discount or not, okay? So I'll give you an example. So up to about 6 weeks ago, cybersecurity names were all the rage, and everyone's so excited about cybersecurity names. And in the last 6 weeks, many of these names have been just chopped by 30% or even more. And if you look at the cohort, you're trying to think within this group, am I buying the cheapest one? Because the story is very attractive for all of them, and there's a very strong tailwind to all these businesses. But so you're trying to get the valuation to work on your side. Try, if possible, to invest alongside founders. When the founder has a significant amount of ownership in the stock, you know it's their idea. Because it's one thing to be a mercenary CEO. You come in and you kind of hire to stay in the job for 5 years, and you're going to try and turn it around and try and drive it forward. That's one thing. But if you were the person that originated the idea, okay, I have this idea of this business, that we're going to go and grow this business, it's a different type of attitude and it's a different type of mentality, because that's all the person has in their life. There's not like plan B, there's only that plan A, there's no other door. So they will drive as much as possible the business forward. So think about the valuation, think about aligning yourself with management that has a lot of incentive, think about the quality of the business. Try and think, does the business have a path to profitability that is realistic in the next several years? So really try and think through about that. And lastly, which is really, really important, is learn, as difficult as it is, to just sit on your hands. And particularly right now, a lot of people say, Michael, the market is up, market is down, should I buy, should I sell? You don't have to act. It's very much okay for you to just sit on your hands and just ride out the storm. If you have some spare capital, now is a good time to buy. But if you don't, it's fine. That's you just ride it out. But by all means, do make it a habit towards the start of each month when you get your salary, and just make it a decision, an automatic decision, to add a little bit of your savings, of your salary towards your savings. And if you make it an automatic decision, it doesn't matter too much whether the market is up or the market is down. It's just really you are staying there and you're just compounding over time and letting your savings compound over time too. Okay, we had a few problems at the start. It wasn't how I wanted to run the podcast. Ended up doing like this. But yeah, I hope that this was helpful. If it was helpful, please do drop me likes. And yeah, thank you so much for listening. I'll see you next week. Hopefully next week we'll be back to normal. Okay, bye.